Hi everyone, welcome to today's video. So if you take a look around in the market right now, you will find some really interesting buying opportunities. You will see companies like PayTM that have fallen by roughly 45-50%. You will have Zomato that has fallen by roughly 35-40%. Even internationally, big companies like Netflix have lost a lot of value over time. So you might feel that, okay, these are companies that I keep reading about in the newspaper every single day. There is so much chatter on social media around these companies. They are available at such an attractive price, almost 50% off. So should I go and just invest my money? Because how much further will these stocks fall? So this is precisely what we are going to discuss on today's video, that there are so many interesting opportunities that are up and coming. All these different companies look revolutionary. So should we be taking positions in these companies, or should we just wait and watch a little bit? How is it that we should be making decisions? So I will help you understand the argument about these up and coming companies by teaching you specific frameworks. So there are 4 specific attributes or strategies that I'm going to teach you today. By identifying these, you will be able to avoid overvalued companies and save a lot of your money. In case you are stuck with some of these companies right now, I will also speak towards the end what is it that you should be doing. So let's get the video started. I will speak in a point format and I will discuss 4 specific points about these overvalued companies. So if you're making a decision to buy Netflix right now, PayTM, Zomato, or companies like these, the first thing that you must question yourself is that are these companies in a red ocean? So what is meant by red ocean? Let me quickly explain that. So there are 2 types of oceans. The first ocean type is called as blue ocean, and blue ocean simply means that it is a calm and composed place and there is not a lot of competition in this particular pool or ocean. A classic example will be of Zerodha, that when Zerodha started out, it was zero brokerage and there was no other competitor that could compete with Zerodha at that point in time. Now, a lot of companies have come up, even Zerodha is changing its business model and bunch of different business changes are happening. But when Zerodha started out or started becoming profitable, the ocean in which Zerodha was competing, it was still blue ocean. There is a separate video that I had done on this topic. You can go and check it out. It's a case study that I had made on Zerodha. You will learn a lot. But I hope this helps you understand the concept of blue ocean. Now, second comes the concept of red ocean. Now, red ocean simply means that there is a lot of infighting that is happening in this particular space. So a lot of companies are coming into this industry. The firms are not profitable yet, or firms have not figured out what their specific business strategy is, but a lot of competition is entering and therefore this ocean is filled with blood because there is a lot of infighting that is happening. So now let us contextualize this point from a buying opportunity. So right now, if you take a look at Netflix, what is it that you will figure out about its business model? There are a couple of things that you will see. One is that you can take a look at this particular revenue chart here. I have picked it up from Vested and you will see that revenues have been growing year on year. So this will seem like a great business model and no doubt about that. And up to a certain point, this increase in revenues also got reflected into the stock price. But what has started happening in the last 1.5 to 2 years is that every single major tech player in the world, it has started to come after Netflix business. For example, Google's OTT platform is YouTube. Similarly, Apple is into Apple TV. Similarly, Amazon is into Amazon Prime. Disney is into Disney Hotstar. All the major tech companies in the world, they are competing head on now with Netflix. And since when this industry has started changing? This industry has started changing from approximately 2020 onwards, because that is when majority of the players like Disney and Amazon started really pushing their OTT business. So to cut the long story short there, Netflix is in the OTT space and this entire OTT space is becoming what? It is becoming red ocean. So therefore, despite a major correction in Netflix stock, I would not go and invest in something like Netflix right now, because we don't know till what point this infighting within this red ocean is going to continue. So it becomes a major pain point for us as retail investors. Now here is a very quick homework for you and I would love for you to comment in the comment box. So take a look at PayTM's business model and tell me what parts of PayTM's business model are in blue ocean compared to red ocean. So I would love to read your answer and let's move on to point number 2. Now point number 2, to identify what type of emerging businesses to avoid, you must understand the concept that being too early, especially in a non-monopoly based business, that can be really bad. A classic example would be that of Suzlon Energy, and here is a chart for you. You will see that back from 2010 to 2015, there was a lot of good narrative about green energy, clean energy, sustainable sources of energy, and almost every energy based company was getting very high valuations. But from 2010 to 2015, the cost structure of these energy-based companies was very, very high. For example, if you know about solar panels used to cost a lot of money back in 2010. So the entire cost structure of this energy-based companies was way off. And companies like Suzlon Energy, they kept on aggregating more and more and more debt. It never translated into profits, not because Suzlon Energy was fundamentally a bad company, nothing like that, but simply because of the fact that this industry itself was premature for its investors. Now, it is very difficult for us as retail investors to make a sense whether an entire industry is premature or not. So what I would generally recommend is that, for example, if you are seeing an excellent opportunity, for example, pick the case of EV industries right now. Right now, EV industry is also premature. There are no clear emerging winners that are coming out. The cost structure still is very high. If you go and try to buy an e-bike or an e-scooter right now, it is very expensive. Even here, the cost structure needs to come down. But if you're having that FOMO, fear of missing out on this industry, then take a little bit of position only. Don't invest a lot of money. I still get a lot of messages from people that Akshat, I invested like lakhs and lakhs of rupees in Suzlon Energy. I'm still stuck with the stock. What should I do? As long as you have invested little bit of money from experiment point of view, it is fine. But if you take bulk positions in untested industries, then it becomes a problem. So be sensible there and don't take massive positions in these emerging industries. Also, from an investment point of view, there is a very important side point here that if you are looking to invest in premature industries, look at companies that have pivoting abilities, right? So let us understand this point by depicting a specific example of Disney versus Netflix as an investment opportunity. Now, Netflix is purely an OTT platform. If the OTT narrative does not play out in the market, or if there is a lot of competition in the OTT space and Netflix would have to keep on cutting its prices every now and then from a business growth viewpoint, Netflix business is not going to grow much. On the flip side, Disney, on the other hand, is a company that is not purely an OTT platform. Disney has theme parks, Disney has kids books, Disney has movies, Disney has a bunch of different things. The most important aspect of Disney's business is that Disney owns different brands. Those brands have massive value. But on Netflix side, it's not as if that Netflix is owning a brand. Yes, last year they got like Squid Games. It got them good business, great for them. But next year again, they will have to reinvest that entire content generation engine and figure out the next winner. But in Disney's case, what ends up happening is that if they have released Frozen 1, if it has done well, then they release Frozen 2, 3, 4, 5, 6, 7. That itself becomes a great branding channel for Disney. And Disney has a great pivoting ability because it is not solely dependent on its OTT revenues. So are you better off investing in Disney or Netflix? I would say Disney. And that is where I am also taking bet. I am not taking bet on Netflix right now. Now comes a third and very interesting point about the first mover disadvantage. Now you'll say, Akshat, I have heard of first mover advantage. What is first mover disadvantage? Actually, there is a very interesting story around it. This entire concept of first mover advantage was given by two Stanford professors. And 10 years down the line, they revised their own theory about having first mover advantage. And they talked about the fact that in fact, you end up having first mover disadvantage. Now, here is a paragraph. You can read more about this here. Very, very interesting concept. And professors' names are David Montgomery and Marvin Lieberman. And it is very clearly written that the irony is that in retrospective paper 10 years later, author backed off from their claims. Now, it is very important for us to understand that why does this happen? Actually, what ends up happening is that first movers in several innovative industries, they have a lot of cost disadvantage. Now, what do I mean by that? So let me show you a chart here. This is regarding 2020 Google's Play profit margins. Now, you can see from this particular chart that Google Pay profit margins improved substantially. Now, if you take a look at this particular paragraph, you will see that these numbers come from a time when none of the competitors in the UPI space have been able to make any money. Players in space such as PayTM and PhonePe have been deep into losses due to high marketing and cashback spends. Now, one could clearly argue that PayTM got a significant advantage when demonetization drive was announced in 2016 and PayTM spent like insane amount of money educating people as to why digital payments are much better. They took something called as customer education cost. Now, interestingly, by the time Google Pay came into the picture, Google Pay already got an entire customer base that was entirely educated about the UPI and online payments. So they did not have to spend money in terms of educating customers about this issue. So as a result, not being early in the game proved advantageous for Google Pay. Now, from an investment point of view, again, I can pick up the case for Netflix and even PayTM right now. And here's a chart for you. You can take a look at Netflix spent on content, and you will see that Netflix is burning like insane amount of money in terms of generating content. In 2021, they spent $17 billion in terms of generating content. Now, if companies like Disney or companies like Amazon are able to bring down this cost, it can prove to be significantly advantageous for these companies. And as a result, the profit margins of Netflix will go down. And as a result, Netflix over time might become less competitive. I'm not saying that this will definitely happen, but all I'm trying to say is sometimes when you identify these types of early mover businesses, it might not necessarily be good. So don't be in a hurry to invest in the new thing that is coming up. Now, where am I seeing this narrative? I'm seeing this narrative in an EV company in India, and you can guess the name in the comment box. Which company am I talking about? And exactly a similar story might play out there. Now, the fourth factor that should dissuade you from investing in a new business would be the philosophy of kitchen sink approach. Now, what is the meaning of kitchen sink approach? So, kitchen sink approach is basically a phrase that has been picked from the US lingo. In US, it simply means that when people don't know anything, they just keep on throwing dart on the ball, hoping that something sticks. So similarly, you will see a lot of companies that are not sure what they are doing. They will just keep on experimenting with everything that comes in their way and are hoping and praying that something will stick. Now, a classic case here would be PayTM, that PayTM is not sure what they are doing. They just keep on experimenting with one business model after the next, and they are trying to just literally create an umbrella. They are into VC also, they are into payments bank also, they are into bunch of 100 different things. Now, some of these models might succeed. I'm not saying that these will not succeed. But for us as retail investors, we don't know when this success will come, and we don't know the internal dynamics of the company. So unless these internal dynamics of the company is sorted, and unless the business model to you is clear, please don't go and invest in companies that are running this kitchen sink approach. Let me know in the comment box what other companies do you think are experimenting with a kitchen sink approach. So a very quick summary: if you see one of these 4 attributes on a business, please avoid it. The first is that red ocean, too much competition coming in right now and the market is not big enough. For example, OTT space, then it's a red ocean. Second, premature industry, that industry is ahead of time, cost structure has not been sorted yet. A classic example here will be EV industry in my opinion. Third, first mover disadvantage. If you find a company that is just way too early, its profit margins are not sorted, it is spending insane amount of money in terms of educating customers. For example, PayTM in 2016-17. This is something that you should avoid. And finally, avoid companies that are experimenting a lot. So this is called as kitchen sink approach. If you keep these 4 points in mind, you will be able to weed out a lot of bad businesses for retail investment. Now you would say, Akshat, markets have fallen so much. So any advice in terms of what we can buy versus not buy? What are some of the key things that we should keep in mind? So I'll leave you with 3 specific points. So the first key thing is that on these emerging businesses, look for clear winners. If you can figure out a clear winner, then go and invest. There is absolutely no problem. For example, a company like Coinbase, it has fallen a lot, no doubt about that. But Coinbase is a clear winner in terms of crypto investments in the US. It is the number 1 ranking firm. And as and when the crypto market recovers, something like Coinbase will have to recover. There is absolutely no problem there. Number 2, invest in diversified tech or companies that have an ability to pivot. For example, consider investing in something like Disney or Amazon because the entire ecosystem play is being designed by these tech companies. Netflix, on the other hand, is a pure play OTT platform. It might not be able to diversify its businesses. So Netflix would not become as expensive. So the word of the day today is expansive. Let me know what does that mean. So Netflix might not become very expansive with time and might struggle to compete with something like Amazon or Disney. Third and most important point, please be okay in terms of buying a business which is good but which is also expensive. You don't need to always go and buy things cheap. If you are buying a really good company with great prospects, and if it keeps on growing and if it keeps on generating cash flows for you, then the stock price will automatically keep on going up. So try to identify good businesses that can survive. That is the magic of investing. I hope you enjoyed the video. Please give it a thumbs up and I'll see you tomorrow.